A beautiful feature to a high cash value life insurance policy is that you can take policy loans. If I have a high cash value policy, call it with $100,000 in cash value, that continues to compound. I earn dividends on the full $100,000. Now, if I take a loan, call it $50,000, I'll continue to earn dividends on the full $100,000 as if I never took a loan in the first place. That's a nice feature. A lot of people are attracted to it. What I want to talk about in today's video is a topic of proper verbiage, meaning when you are going to take a loan, do you take a loan or borrow against the cash value of your life insurance policy, or do you take a loan or borrow from the cash value of your life insurance policy? And for years, we got this question, mainly from agents who would say, hey, it's borrow against. Some would say borrow from. And I would just kind of leave it to say, hey, it doesn't really matter. But more recently, we have gotten this question from some consumers. There's been more noise or more attention directed toward it. So like, okay, we can definitely provide some transparency around the proper verbiage and if it really matters. So when it comes to policy loans, do you borrow from or do you borrow against the cash value of a life insurance policy? And why this is important is not really from the consumer standpoint because it doesn't really matter, meaning if you take a policy loan, it's going to function how a policy loan functions. From an agent perspective, because this is the financial services industry, there is a measure of compliance, meaning what we say, how we speak, the words we choose are very, very important. So here's my stance on it. Doesn't matter. If I say you borrow against a life insurance policy or if you borrow from the cash value of your life insurance policy, they mean the same thing from the consumer's perspective. Now, back to the compliance issue, which is very important to touch on, it doesn't matter either. And a nice way to validate that is looking at insurance companies and their compliant approved literature, which we always look at, including literature from the company that is approved and distributed to agents, to consumers. You can look at contract language and actual life insurance policies. And here's the thing. You'll see both borrow against and borrow from in insurance carriers' literature. And you can look at different insurance companies and you'll see this to be so consistent. So let's take a look here. We're going to look at two different companies. What I'm going to begin with is as follows, not this guy, but this guy. So what we've got here is an advertising and marketing compliance standards for whole life insurance. So this is one of my favorite pieces. I found it, I believe it was last year, or it may have been actually more than a year ago. I don't know. The point is, this actually gives not just the proper language, but specific word tracks and sample language with respect to how certain components of whole life insurance policy can and cannot be explained to potential policyholders if you own a whole life insurance policy. So, as an example, here's premiums and premium payments, where in the industry, we're often advised, or we are advised, not to refer to a premium payment as a contribution, because that can be confusing, makes it sound as if I'm contributing to a bank account, contributing to a 401k. Companies don't like that. However, if I use distinct language such as premium contribution or premium deposit with the word premium in front of it, it's no problem. So, and you've got sample language here that validates it as well. So the point is we want to make sure we do that research. Same thing with the cash value, sample language. But the purpose of today's video is really to cover what? Loans, borrow against or borrow from. So here we go. We've got it highlighted in yellow. Here is compliant approved language with respect to accessing the cash value through loans or withdrawals. Here we go in yellow. When communicating a policyholder's ability to withdraw or borrow from the cash value of a whole life insurance policy, goes on with disclosure and such. Does it say borrow against? No, it says borrow from. If we look at the sample language, so this refers to what I, an agent, would say to you, a potential policyholder. This refers to what is approved. And what do we see? Cash value accrued over the years in your life insurance policy will be an asset at your disposal that you may withdraw or borrow from to assist assist you in financing a life event. Borrow against, borrow from. So again, there's a lot of opinions, a lot of things we hear frequently. At the end of the day, if you're a consumer interested in a policy, again, it doesn't matter. Here we see borrow from. I try not to get caught up in the noise too much. Now, let's look at a different company here, a behemoth of a life insurance company, Mass Mutual. Another piece here. This is literature for consumers with respect to the cash value accumulation. What do you see here? Whole life policy cash values can be borrowed from the policy for any purpose. Can be borrowed against the policy? No, it says borrowed from the policy. This is from the insurance company, their literature, all compliant approved. Now, look at this piece. Life insurance tax advantages. Policy cash values accumulate tax deferred and distributions from the policy. Distributions from the policy, not against the policy. Let's continue on here. Got another piece. I like this piece a lot because this actually refers to the example of borrowing against equity in your home. So do I borrow from a home or do I borrow against my property to get a loan from the bank? Borrow against. And they use that specific language here too. So companies use both of this, both borrow against and borrow from. If you borrow against the equity of your house, if you choose to borrow part of the value of your whole life policy, referring to the same analogy there. Now, if we look at another piece here on borrow against, life insurance buyer's guide, anytime you buy a policy with any company, typically you're provided something along these lines. Look at this. You may borrow against a policy's cash value by taking a loan. You may borrow against. So what have we seen thus far? Borrow from, borrow against. Here's a piece on Mass Mutual's dividend history. What do you see here? If a policyholder selected the fixed loan rate provision with their policy, borrowing, what's that word? From the policy, may impact the investment component of the dividend. This is specifically referring to their direct recognition treatment with Mass Mutual. If you select their fixed loan interest rate, it's actually the policy becomes direct recognition and the dividends adjusted. But my point says borrow from the policy. Now let's look at one more piece here. This is a resource for individuals and families. So this is available to the public. We can distribute it to anyone. Here we go. Specific language we see here under loans. Let me blow that up a little bit. There we go. What do you notice? Money borrowed from the policy. And then what do we see here? Let's look at some of the considerations when policyholders try to decide whether to take a withdrawal and or a loan from a permanent life insurance policy's cash value. Often when we describe how policy loans work, we can borrow from the cash value, borrow against the cash value, borrow from the cash value, take a withdrawal and or a loan from the permanent life insurance policy's cash value. Like, it doesn't matter at the end of the day. For the consumer standpoint, if you're looking at a policy and you're trying to understand how policy loans work, here's simply what I would look at. With a policy loan, how does it work? Well, if you have cash value, in this example, call it of $100,000, and you don't touch it, let's assume you've got a policy with a dividend rate of 6%, which means your net internal rate of return, your net growth rate, will likely be around 4% or so, depending on how many years you're in the policy. But earning 4%, so we've got that dividend rate of 6%. If I don't touch the money, 6% dividend on the full $100,000. Let's assume you decide to borrow $50,000. You take a loan of 50 grand. What do we see? There's a cost to borrow. The interest rate may be 4%, which goes to the insurance company. However, the company is going to continue to pay you that 6% dividend on the full $100,000 as if you never touched it in the first place, assuming the policy is non-direct recognition. If it's direct recognition, it'd be a little bit differently. So another way to explain it is that 6% dividend is still applied to any money in cash value. I like to refer to this as remaining equity or outstanding in policy loans. So as an example, if you were going to repay your policy loan, let's say you weren't going to touch it, and in 10 years from now, that cash value was going to be worth $200,000, and I elect to borrow from the policy 50 grand like I see in this example, then pay it back in 10 years, it'll be worth that same $200,000, meaning loans do not interrupt the compounding of a policy at all. So I hope you found this video helpful. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.